Right now, at this very moment, there are millions of Americans, retired, hardworking people who did everything right, sitting completely unaware that the money they've been safely parking in their checking account could be quietly triggering a brand new IRS scrutiny process. And here's the thing that nobody in your family, your bank, or your financial advisor has probably told you yet. There is a specific dollar amount that once you cross it, puts you directly under the microscope. And if you're retired, the impact is not just annoying, it can be financially devastating. My name is Marcus. If you've never heard about this before, stay with me for the next few minutes, because what I'm about to share could literally save you thousands of dollars and a whole lot of stress. So let's start at the beginning, because this story really matters. For decades, Americans were told one simple thing: keep enough in your checking account to cover your bills, your emergencies, and your peace of mind. That was the standard advice. That was the safe play. Banks loved it. Financial advisors encouraged it. And retirees especially leaned into it, because after a lifetime of working, the last thing you want is to worry about whether the money is there when you need it. So people kept $5,000, $10,000, sometimes $20,000 or $30,000 just sitting in their checking accounts. Felt safe, felt responsible. But here's what changed. And it changed quietly, without a lot of fanfare, without a press conference, and without anyone sending you a letter. The IRS and financial regulators have been tightening their grip on bank account monitoring. And the number that's getting people flagged, the number that's suddenly putting retirees and everyday Americans on a watch list, is $10,000. Now, you might have heard that number before in the context of cash transactions, but what most people don't realize is how broadly that threshold is now being applied and what happens when you stay consistently above it in your everyday checking account. This isn't just about withdrawing cash at the teller window anymore. This is about your total balance sitting there day after day, month after month, and the patterns your account creates over time. And for retirees who are receiving Social Security, pension checks, required minimum distributions, and maybe some investment income, all flowing into the same checking account, this is where things start to get complicated fast. Here's something most people have never been told, and I want you to really pay attention to this part. Banks in the United States are legally required to file what's called a suspicious activity report, or a SR, whenever they see account behavior that seems inconsistent or unusual. Now, the word suspicious makes it sound like they're watching for criminals. And originally, yes, that was the intent. The Bank Secrecy Act was designed to catch money launderers and drug traffickers. But over the years, the definition of what looks suspicious to a bank's automated system has expanded dramatically. And one of the biggest triggers, especially for retirees, is a consistently high checking account balance combined with irregular large deposits or withdrawals. Your Social Security check hitting on the 3rd of the month, your pension arriving on the 1st, your RMD landing in December, all of that can create a pattern that an algorithm flags without a single human being ever looking at your actual situation. And this is where the new IRS rule comes in. And I want to be precise here because I know some of you are going to fact check this, and you should. The current administration and the IRS have been pushing for expanded bank reporting requirements. Under existing regulations, banks are already reporting transactions over $10,000. But the proposal that's been circulating, and in some modified forms already taking effect, would require banks to report gross inflows and outflows on accounts that exceed certain thresholds annually. The number that was originally proposed was accounts with more than $600 in annual activity, which honestly sounds absurd. But even in its more scaled back versions, the intent is clear. The IRS wants more visibility into your accounts, and that means more cross-referencing, more automated flags, and more letters landing in your mailbox asking you to explain your finances. Now, why does this hit retirees harder than anyone else? And this is the part where I really want you to lean in. Retirees are uniquely vulnerable to this for several reasons. First, you tend to have multiple income streams. You've got Social Security, you might have a pension, you might have investment accounts distributing dividends, you might be selling property or drawing down on a 401k. All of that flows somewhere, and most people, for simplicity, funnel it all into one checking account. That account then looks very active to an algorithm: large regular deposits, large withdrawals, high average balance. Second, retirees often receive large lump sum payments, an RMD in December, an insurance settlement, the proceeds from selling a vehicle or a piece of land. Those one-time large deposits are exactly the kind of things that trigger automatic flags. And third, and this is the one that really stings, retirees are less likely to have a financial advisor sitting right next to them saying, "Hey, let's structure this more efficiently," which means the problems build up silently until they become real problems. And I want to pause here for a second because I know some of you are watching this and thinking, okay, so what's the actual worst case here? So let me be honest with you. The worst case isn't just getting a letter from the IRS. The worst case is what comes after that letter if you're not prepared. First, there's the audit. Not a full-blown sit-down with an agent audit necessarily, but an automated correspondence audit where the IRS is asking you to justify specific deposits or activity. That means paperwork. That means time. That means potentially hiring a tax professional to respond on your behalf. And tax professionals don't work for free. Yet a good CPA or tax attorney can run you anywhere from $200 to $500 an hour. Then there's the potential issue of penalties. If the IRS decides that money you received was income you didn't properly report, maybe that large gift from a family member that someone didn't structure correctly, maybe those proceeds from a small sale you didn't think counted, suddenly you're dealing with back taxes, interest, and penalties that compound on each other. For someone on a fixed retirement income, that's not just inconvenient, that's genuinely life disrupting. And by the way, if you're still watching this video, Ian, and I'm glad you are, please do me a quick favor right now. Hit that like button and subscribe to Growth Harrison right now if you haven't already. We put out content specifically designed to protect everyday Americans from the kind of financial traps that the mainstream media glosses over. There's a lot of noise out there, but we stay focused on what actually affects your wallet and your retirement. So tap subscribe and let's keep going because we're not even halfway through what you need to know. Now let's talk about the actual number. The question this video asked right in the title, how much is too much to keep in your checking account? And the honest answer based on current banking norms, IRS scrutiny patterns, and financial planning best practices is this. Most financial advisors will tell you to keep no more than 1 to 2 months of living expenses in your checking account at any given time. For the average American retiree, that typically works out to somewhere between $3,000 and $8,000. Now that might feel uncomfortably low to some of you, and I understand that instinct completely. There's something psychologically reassuring about seeing a big balance in your checking account. It feels like security. But here's the thing, that feeling is an illusion, and it's an illusion that's costing you in multiple ways. First, the obvious one. Checking accounts pay almost nothing in interest. We're talking 0.01% at major banks in most cases. While inflation is running at 2, 3, 4% annually, every dollar sitting in your checking account is losing real value every single day. Meanwhile, high-yield savings accounts, money market accounts, short-term treasury bills, and these are paying 4, 5, sometimes even higher percent right now. That means someone with $20,000 sitting in their checking account instead of a high-yield alternative is potentially losing $1,000 a year or more in opportunity cost over a 10-year retirement. You're talking about real meaningful money that you left on the table simply because nobody told you there was a better place to put it. Second, and this is the one that connects directly back to our main topic, keeping too much in checking increases your risk of being flagged. The more your average daily balance sits above $10,000, the more your account looks like something worth investigating. To an automated system that doesn't know you're just a cautious retiree who prefers the peace of mind of a large cushion. The system doesn't know you, it just sees numbers. And the numbers tell a story that unfortunately pattern-matching algorithms are now trained to flag. So what should you actually do? Let me walk you through a practical strategy that works for real people in real retirement situations. This isn't theoretical. This is what smart retirees are actually doing right now to protect themselves. The first step is to separate your money into what financial planners call buckets. Your checking account is your operational bucket. It's for bills, groceries, gas, and day-to-day spending. It should have just enough to cover your monthly expenses comfortably, plus maybe a small buffer of $1,000 to $1,500 above that. That's it. Think of your checking account like a wallet, not a vault. You don't carry your life savings in your wallet, and you shouldn't keep your life savings in your checking account either. Your second bucket is your short-term reserve. This is your emergency fund, your rainy day money, the cash you'd need if your car broke down or you had a medical bill come in unexpectedly. This money should live in a high-yield savings account or a money market account, ideally at an FDIC-insured institution. Keep 3 to 6 months of expenses here. If your monthly expenses are $4,000, that means keeping $12,000 to $24,000 in this second bucket. And because it's in a separate account from your checking, it doesn't inflate your day-to-day balance and it earns you real interest in the meantime. Your third bucket, and this one is especially important for retirees, is your medium to long-term money. This is where you put funds you won't need for at least a year or more. Treasury bills, CDs, bond ladders, dividend-paying stocks if you're comfortable with some market exposure. These are all options depending on your risk tolerance and timeline. The key point is that this money should absolutely not be sitting in a checking account, earning nothing and attracting IRS attention. It should be working for you, earning real returns, and sitting in accounts that are structured specifically for that purpose. Now let's talk about something really specific that a lot of retirees don't think about. Required minimum distributions, or RMDs. If you're over 73 years old and you have a traditional IRA or a 401k, the IRS requires you to take a minimum distribution every year. And here's the thing, many people receive their RMD as a large lump sum in December and they just drop it into their checking account. That single transaction alone can easily be $10,000, $15,000, $20,000 or more depending on the size of your retirement account. And that deposit hits your checking account like a signal flare from the perspective of automated bank monitoring systems. A much smarter approach is to spread your RMD across the year if your plan allows it. Take monthly or quarterly distributions instead of one big annual one. This smooths out the pattern, reduces the size of any single transaction, and also helps you manage your tax situation more efficiently because you're not getting hit with a massive ordinary income event all at once in December. Along the same lines, Social Security planning matters here more than most people realize. If you're receiving Social Security and you're also drawing from retirement accounts, you need to be thoughtful about how much of your Social Security becomes taxable. Here's a fact that surprises a lot of retirees. Up to 85% of your Social Security benefits can be subject to federal income tax if your combined income exceeds certain thresholds. The more income you have flowing into your household in a given year, the more likely you are to push yourself into a higher tax bracket and trigger greater IRS visibility. This is why it pays, literally pays to have a strategy, not just a savings balance. Let me also address something that comes up a lot in comments and conversations, the idea of just keeping cash at home to avoid all of this. And look, I get it. There's an appeal to the idea of just having physical cash in a safe where no algorithm can flag it. But I want to be straightforward with you. That approach carries its own serious risks. Cash at home is not FDIC insured, meaning if your house burns down or you get robbed, that money is simply gone. Cash holdings above $10,000 can also create legal complications if they're ever discovered and you can't prove the source. And frankly, large amounts of cash tend to depreciate every single day just sitting there. It is not the answer to this problem. The answer is smart account structuring, not hiding money under the mattress. Here's another angle on this that we need to address. Joint accounts and family transfers. A lot of retirees receive money from adult children, help with bills, gifts, contributions toward household expenses, and a lot of retirees also give money to their children and grandchildren. Family financial support is one of the most common and most misunderstood areas when it comes to IRS rules. For 2024 and 2025, the annual gift tax exclusion is $18,000 per person. That means you can give any individual up to $18,000 in a year without it triggering a gift tax return. But if you go over that amount even by a dollar, you're technically supposed to file a Form 709. Most people don't know this. Most people have never filed a 709 in their lives. And most people have at some point transferred an amount that, if added up across the year, probably exceeded that threshold without any tracking or documentation. This is exactly the kind of thing that starts as a small oversight and becomes a real problem if you get flagged for something else and the IRS starts pulling on threads. Now I want to shift and talk about something that's becoming increasingly important in 2025 and beyond: digital payment platforms and how they connect to all of this. Venmo, Zelle, PayPal, Cash App. These platforms have fundamentally changed how money moves between people, and the IRS has fundamentally changed how it views those movements. Starting with the 2022 tax year and accelerating since then, the IRS has been implementing new reporting requirements for third-party payment platforms. If you receive more than $600 in a calendar year through a platform like PayPal or Venmo for goods and services, that platform is now supposed to issue you a $1,099K and report it to the IRS. This caught millions of people completely off guard. People who were just splitting dinner bills or getting reimbursed for a family trip suddenly started receiving tax forms they had no idea were coming. For retirees who might be selling things on Facebook Marketplace or eBay, doing occasional consulting work, or even just receiving regular transfers from family members on these platforms, the exposure here is real. And here's where it connects back to your checking account strategy. Many people have their Venmo or PayPal or Zelle linked directly to their primary checking account. Every transfer flows in and out of the same account where your Social Security check arrives and your mortgage payment leaves to the IRS's automated systems. All of that activity is being weighed together. It creates a picture of your financial life. And if that picture is messy, even if every single dollar is completely legitimate, the messiness itself can attract attention. The cleaner and more organized your financial structure is, the lower your risk profile becomes. It really is that simple. Let me bring this back to something practical and give you a concrete action plan, because I don't want you leaving this video with just anxiety. I want you leaving with a plan. Step 1. Today, not next week. Today, log into your checking account and look at your average daily balance over the last 3 months. If it's consistently above $10,000 and you don't have a specific reason for that, you need to act. Step 2. Open a high-yield savings account if you don't already have one. There are several online banks right now offering 4 to 5% APY with no minimum balance requirements and full FDIC insurance. Move your emergency reserve there. Keep only your operational money in checking. Step 3. If you're receiving an RMD, talk to your plan administrator about converting to monthly distributions instead of an annual lump sum. Step 4. Review your digital payment platforms and make sure you understand what's being reported to the IRS and what isn't. If you're selling things regularly or receiving consistent payments, make sure you're tracking those and accounting for them on your taxes. Step 5, and this one is the most important. Consider sitting down with a fee-only financial advisor or a CPA who specializes in retirement planning, not someone who earns commissions selling you products. A fee-only advisor who is legally obligated to act in your interest. The cost of 1 or 2 sessions with a qualified advisor is almost certainly less than what you'd pay dealing with an IRS inquiry down the road. Here's something I also want to address specifically for those of you who are married or in a partnership. Joint account strategy matters enormously here. Many couples run everything through a single joint checking account. Both Social Security checks, both pensions, investment income, everything. The combined deposits can easily put that account into territory where it looks very active and very high balance on paper. Separating some income streams into individual accounts and while making sure beneficiaries and account access are properly set up can reduce the visual noise on any single account and create a cleaner paper trail if questions ever arise. And let's talk about one more thing that retirees often overlook: the relationship between your checking account activity and your Medicare premiums. This is something called IRMAA, the Income-Related Monthly Adjustment Amount. Medicare Part B and Part 500 premiums are based on your modified adjusted gross income from 2 years prior. That means what you earn and report today affects what you pay for Medicare 2 years from now. Large one-time distributions, selling a rental property, taking a big Roth conversion, receiving an inheritance that generates taxable income. All of these things can push your income into a higher bracket in a single year and result in significantly higher Medicare premiums 2 years later. It's not a direct IRS scrutiny issue, but it is a very real and very underappreciated consequence of letting large sums of money flow through your financial accounts without a plan. The solution isn't to earn less money. It's to structure when and how you recognize income in a way that keeps you below those IRMAA thresholds where possible. I've covered a lot of ground in this video, and I want to do a quick recap so this all sticks with you. We talked about why keeping too much in your checking account, specifically above that $10,000 threshold on a consistent basis, puts you at greater risk of being flagged by your bank's automated monitoring systems and by IRS cross-referencing programs. We walked through the new and evolving IRS reporting requirements that are making it more important than ever to have a clean, organized financial structure. We gave you a real practical framework, the bucket strategy for where your money should actually live and why your checking account should function more like a wallet than a vault. We covered RMDs, digital payment platforms, IRMAA, gift tax rules, and joint accounts, all the pressure points where retirees are most vulnerable to unintended financial exposure. And we gave you a 5-step action plan you can start on today. The bottom line is this: the financial landscape has changed. The rules have changed. The technology the IRS and banks use to monitor account activity has changed. But most of the advice that retirees are running on was written for a different era. The people who are going to come out of this environment in the best shape are the ones who update their strategy to match the current reality, not out of fear. Not because the government is out to get you, but because being smart and organized is always better than being caught off guard. Before I let you go, I want to ask you something. Did anything in this video surprise you? Did you learn something that you genuinely didn't know before? If the answer is yes, please drop a comment below and let me know what it was. Your comments don't just help us understand what content matters to you. They actually help other viewers who are scrolling through those comments trying to figure out if they should watch this video. Your 2 seconds of engagement genuinely helps real people make better decisions. So please drop a comment, even if it's just, "I had no idea." It matters more than you know. And if you have a friend or a family member who's retired or close to retirement and you want to do them a real favor today, share this video with them. Not because it's entertaining, but because the information in it could protect their financial security at a time in their life when they can least afford to get it wrong. This is OG John AG, and you've been watching Growth Harrison. If this video helped you, hit that subscribe button and turn on notifications so you never miss content like this. We're here every week breaking down the financial rules, regulations, and strategies that actually affect your life. No fluff, no filler, just real information for real people. Take care of yourselves, take care of your money.